If you're a second or third year BS accountancy student here in the Philippines, you already know the pressure is seriously on. You don't just need to memorize tax rules to pass a quiz tomorrow. You literally need to hardwire them into your brain for 3 years down the line when you actually sit for the lekba. Well, welcome to your ultimate brain-friendly explainer. We're going to customize your mental model today to match exactly how your brain encodes and retrieves complex tax timing rules. Let's get into it. Here's our roadmap for today. We've got 6 key areas: accounting periods explained, cash versus accrual methods, special accounting methods, installment method eligibility, installment calculation formulas, and finally, the net worth method. All right, part 1, accounting periods explained. So contrast these two heavily in your mind. The difference is actually pretty simple, but it totally trips up students when they're under exam pressure. The calendar year is your absolute default standard, January 1st to December 31st. The fiscal year, on the other hand, is any 12-month period that ends on the last day of any month, as long as it's not December. The real trick here is knowing exactly who doesn't get a choice. Lock in this LECPA hack right now. Individuals, partnerships, taxpayers who do not keep books, and taxpayers with no annual accounting period are strictly locked to the calendar year. No exceptions. If you see a multiple-choice question where a partnership is trying to use a fiscal year ending in March, you instantly know it's a trap. Now, sometimes a standard 12-month tax year gets abruptly cut short. You need to memorize these 4 specific triggers that force a short accounting period: a newly organized corporation, a dissolved corporation, a legally approved change in the accounting period, or when a taxpayer dies. Keep this active in your recall because examiners absolutely love testing the exceptions. Moving on to part 2, cash versus accrual methods. This right here is the core divide in basic accounting methods. If you're using the cash method, you basically only care about the physical exchange, money actually coming in or money actually going out. But with the accrual method, you're tracking the legal right or obligation. You report the income the exact moment it's earned, and you deduct the expenses the moment they're incurred, completely regardless of the actual cash flow. Next up, Section 3, special accounting methods. So the standard methods just don't work for every single industry out there. If it takes more than a year to harvest a crop or build a massive structure, you can't use a normal 12-month matching principle. For agriculture, farmers use the crop year method. That means you hold off on deducting all those planting and watering expenses until the year you actually sell the harvested crop. And for construction contracts spanning over a year, you have to use the percentage of completion method, which means recognizing your income based on the estimated work completed by the end of that specific year. Let's hit Section 4, installment method eligibility. Let's pause for a second and trigger some active recall. Think about it. Do you know the exact, strict legal conditions required to defer your taxes on an installment basis? Because you can't just choose to pay tax leaders simply because it's more convenient for your wallet. The BIR limits this to exactly 3 categories of taxpayers. Dealers of personal property, think of an appliance store. They have it relatively easy. But casual sellers of personal property and sellers of real property, they face incredibly strict numerical limits. Okay, burn this number into your brain right now. 25%. This is your ultimate anchor metric. For casual sellers and real property sellers, your initial payments absolutely cannot exceed 25% of the selling price. If it hits 25.1%, boom, you lose the installment privilege entirely, and you have to report everything up front. If a casual sale question pops up on your exam, run it through this rapid-fire checklist in your head before you even try touching a calculator. 1. Is the selling price greater than 1,000 pesos? 2. Are the initial payments 25% or less of the selling price? And 3. Is the property a capital asset, meaning it's not just part of the seller's regular inventory? If you get 3 yeses, you are clear to proceed. All right, Section 5, installment calculation formulas. Let's demystify the math here. Look closely at how these 2 formulas interact with each other. The selling price is basically everything the buyer's throwing at the seller: cash, notes, and assumed mortgages. But the contract price is what the seller is actually going to collect in equity. You just take the selling price and subtract the assumed mortgage. The only exception you need to watch out for is if that assumed mortgage is greater than the property's cost. If it is, that excess amount gets added right back in. Guys, this right here is a massive trick question trap that catches so many Gen Z accountancy students completely off guard. Initial payments is not just the down payment. It includes the down payment plus any other installment cash you receive in that entire first taxable year, plus that excess of mortgage over cost we literally just talked about. Do not just look at the day of the sale, you have to look at the entire year of the sale. Once you have your foundational numbers locked in and you survive that trap, you plug them into this master formula. You divide your gross profit by the contract price to get your gross profit ratio. Then you just multiply that ratio by the actual installment cash you received that year. This reveals the precise, exact amount of taxable income you need to report to the BIR. Finally, Section 6, the net worth method. So what happens when a taxpayer's books are just totally missing, incomplete, or super sketchy? The BIR doesn't just throw their hands up and walk away. They go forensic. They work backward. They look at the taxpayer's wealth at the very beginning of the year and their wealth at the end of the year to uncover hidden, undeclared income. To solve a net worth problem on the board exam, you've got to follow these sequential steps exactly as a BIR auditor would. First, find the ending net worth. Second, subtract the beginning net worth to find the total increase in wealth. Third, add back non-deductible items like personal living expenses, because hey, that's money they spend instead of saving. Finally, subtract non-taxable receipts, like an inheritance, because that perfectly explains wealth growth without it actually being taxable income. Once the auditor finishes all those forensic steps, they have the true taxable income, and they calculate the tax on it. If the investigated tax is higher than the income tax the person actually declared on their original return, that gap is the deficiency income tax. And you better believe that's exactly what the BIR will demand, plus some heavy penalties. This thought right here basically sums up our entire session. By chunking this information logically, first the periods, then the methods, and finally the actual calculations, you aren't just memorizing for tomorrow. You are literally hardwiring the hardest tax timing rules into your brain by understanding the mechanism behind taxation. Keep actively recalling these anchor metrics and running through those checklists. When you can instantly visualize that 25% rule in your head, you are building the exact neural pathways you need to absolutely crush the LECPA. Review this explainer whenever you need to refresh those connections. But before you go, let me leave you with this. If the BIR used the net worth method on your personal finances tomorrow morning, what hidden discrepancies do you think they'd find? Think about it. Good luck studying.